Welcome to this video on understanding Warren Buffett's investment strategy. Quote, stock splits have been a popular strategy among companies looking to make their shares more affordable to retail investors. However, Warren Buffett, the Oracle of Omaha, has famously shunned this practice for his own company, Berkshire Hathaway. Despite this, there is one stock split that stands out as a favorite in Buffett's investing history. Buffett has long been an admirer of Coca-Cola. In fact, Berkshire Hathaway started accumulating shares of Coca-Cola in 1988, and today it remains one of the largest holdings in Berkshire's portfolio. One of the notable events in Coca-Cola's history was its stock split in 2012. This 2-for-1 split effectively halved the share price, making it more accessible to a broader range of investors. Stock splits can often be a sign of confidence from a company. They indicate that the company's share price has grown significantly and that it expects continued growth. While it doesn't change the underlying value of the investment, it can lead to increased liquidity and attract more investors. This can be particularly appealing to smaller investors who may have previously found the stock too expensive. In contrast to Coca-Cola, Buffett's own Berkshire Hathaway has famously never split its Class A shares. The high price of these shares, which trade in the hundreds of thousands of dollars, reflects a deliberate strategy to attract long-term investors rather than short-term traders. While Berkshire did introduce more affordable Class B shares in 1996 and performed a 50-to-1 split on these in 2010, the primary Class A shares remain a testament to Buffett's unique approach to stock splits. One aspect of investing that often garners attention is the decision by companies to split their stock. Stock splits are typically seen as a way to make shares more affordable for individual investors, but their impact on actual shareholder value is a topic of much debate. Buffett himself has a well-documented stance on stock splits, often preferring companies that do not engage in such practices. He believes that a high share price reflects a high-quality business and a committed shareholder base. One notable exception in Buffett's portfolio is Apple Incorporated, which conducted a 4-for-1 stock split in August 2020. Despite his general aversion to stock splits, Buffett's Berkshire Hathaway continues to hold a significant position in Apple. This is indicative of Buffett's flexible approach when it comes to exceptional companies that align with his core investment criteria. Despite his legendary stock-picking prowess, Warren Buffett has a well-known aversion to stock splits. In his view, stock splits often result in increased volatility and speculation. However, there's one stock split that stands out as an exception. Berkshire Hathaway, the conglomerate led by Buffett, executed a notable stock split in 2010. Traditionally, Buffett has resisted splitting Berkshire Hathaway's Class A shares, which are among the highest-priced stocks on the market. However, he allowed a 50-to-1 split of the company's Class B shares. This move wasn't driven by a desire to make the stock more accessible to retail investors, but rather to facilitate the acquisition of Burlington Northern Santa Fe Corporation. The acquisition required issuing stock, and the split helped in making this transaction smoother. This strategy underscores Buffett's pragmatic approach to business decisions. He recognized that the split of Class B shares was necessary to meet the specific need of the Burlington Northern acquisition. By creating a more affordable stock class without compromising the high value of Class A shares, Buffett effectively navigated a complex transaction. This decision illustrates his ability to balance financial strategy with long-term value preservation. For investors, this case highlights the rare circumstances under which Buffett endorses a stock split. It serves as a reminder that while stock splits may seem appealing due to their potential to lower share prices and increase liquidity, they are not always aligned with the company's long-term goals. Buffett's selective approach to stock splits calls for careful consideration of the broader context and strategic objectives behind such moves. Stock splits have been a hot topic in the investing world recently, with several high-profile companies opting to split their shares. A stock split doesn't change the market value of a company, but lowers the price of individual shares, making them more affordable for retail investors. Warren Buffett, one of the most successful investors of all time, has taken a keen interest in stock splits over the years. While Berkshire Hathaway itself rarely splits its high-priced Class A shares, Buffett's portfolio is not without companies that have utilized this strategy. For instance, one of Buffett's favorite companies, Apple, has executed multiple stock splits in its history, including its 4-for-1 split in August 2020. This move made Apple's shares more accessible to a wider range of investors, contributing to the stock's continued popularity and ownership diversification. Many investors look favorably upon stock splits as they often signal a company's confidence in its future growth prospects. When a well-regarded company like Apple or another Buffett favorite decides to split its stock, it can attract positive attention and new investment, ultimately driving shareholder value. In addition, stock splits can enhance liquidity, making it easier for trades to be executed without significantly affecting the stock price. For retail investors, lower share prices post-split allow for more flexible investment strategies, such as dollar-cost averaging. While Buffett embraces the practice in other companies, he has famously avoided splitting Berkshire Hathaway's Class A shares. The rationale is to maintain a stable and serious investor base, avoiding short-term traders. Instead, Berkshire introduced Class B shares in 1996, which provide a more affordable entry point for individual investors while still upholding the company's long-term investment values. Despite this unique approach for his own company, Warren Buffett's broader investment actions indicate a strategic appreciation of the benefits that stock splits can bring to a company's market performance and investor appeal. Despite being one of the most widely followed investors on the planet, Warren Buffett places very little emphasis on stock splits. But there is one high-profile company with which Berkshire Hathaway has a massive stake that recently enacted a stock split: Apple, Nasdaq, APL. Berkshire Hathaway began accumulating its position in Apple back in 2016. The Oracle of Omaha quickly realized the value of the iPhone's ecosystem and the loyalty of Apple users. By the end of June 2020, Berkshire had amassed 245 million shares. In August 2020, Apple enacted a 4-for-1 stock split, increasing the number of shares held by Berkshire Hathaway to around 1 billion. A stock split itself doesn't change the valuation of a company. It merely increases the number of shares outstanding while reducing the price of each share proportionally. This makes the stock more accessible to a broader range of investors and can often drive a renewed interest in a company's shares. Post-split, Apple's stock continued to surge, further solidifying Buffett's substantial gains on Berkshire's investment. Historically, Warren Buffett hasn't been a huge advocate for stock splits. He believes that the intrinsic value of a company remains unchanged regardless of the number of shares outstanding. However, his willingness to hold Apple, a company that did choose to split its stock, demonstrates his flexible approach when dealing with high-quality businesses that align with his investment philosophy. Thank you for watching. For more insights into Warren Buffett's investment strategies, don't forget to like, subscribe, and hit that notification bell. Until next time.